Discover the timeless secrets of investment with the brilliant mind of Peter Lynch. In Peter Lynch, How to Invest for Beginners, we explore essential rules, demystify speculation, and reveal the importance of risk management. Learn why looking at the financial statements is crucial and how adopting a long-term mindset can transform your investments. Don't miss out. Watch until the end to unravel fundamental strategies. Be part of this educational journey and subscribe to the channel to not miss any valuable insights.
5. Know your investments. Investing in an informed and strategic manner requires a deep understanding of the rules governing investments, a truth that transcends time. Whether looking back 50 years, 5 years ago, or considering the current scenario, the consistent application of these rules is crucial. Firstly, it is imperative to have a profound knowledge of the assets in which you are investing, whether in funds or stocks. Ownership of these assets should not be an unconscious act, instead, it should be based on a clear and well-founded reason. Avoiding the speculation trap is another essential principle. Betting on the market and expecting quick gains can be tempting, but true financial solidity comes from a more strategic approach. Allocating resources in the stock market cannot be dictated by fixed rules based on the investor's age. Instead, it should reflect a personal and carefully considered decision. A detailed analysis of companies' financial statements is a wise practice. Companies with a strong financial position, characterized by strong equity and low debt, are more likely to withstand market fluctuations and thrive in the long term. A thorough understanding of a company's financial health is therefore essential to support informed investment decisions. Investing with a long-term perspective is an approach that transcends temporary market volatility. Instead of seeking quick gains, attention should be directed to where a company will be in 2 decades. Stocks are not lottery tickets, they are integral parts of companies that have the potential for sustainable growth over time. This long-term view implies a deep understanding of the nature of the underlying business, regardless of the sector in which it operates. In short, proactively managing risks is a distinctive characteristic of a wise investor. Evaluating not only the potential for gain but also the risks associated with each investment is crucial. Success in the financial market does not require being right all the time, instead, it requires the ability to balance occasional losses with substantial gains. Historically, this approach has proven more effective than the relentless pursuit of immediate victories.
4. Avoid speculation. It is crucial to dissuade oneself from speculation when entering the financial market. The practice of making investments as if they were mere bets, hoping for arbitrary gains, does not constitute a sustainable strategy. Instead, a prudent approach requires careful and reasoned analysis, moving away from the gambling mentality that often permeates the investment environment. The decision regarding the allocation of resources in the stock market should be viewed as a personal choice, distant from inflexible rules based solely on the investor's age. Establishing the percentage of capital to be invested should not follow a predetermined pattern related to age. Instead, it requires a careful assessment of individual financial goals, risk tolerance, and investment time horizon. The investment strategy should transcend the pursuit of immediate gains, focusing on building a portfolio aligned with the investor's long-term goals. Abstaining from speculation implies adopting a more grounded approach, where asset analysis, understanding market conditions, and risk assessment are essential elements in making investment decisions. In short, avoiding speculation not only preserves long-term financial stability but also promotes a responsible investment mindset. By moving away from the quest for quick returns and adopting a more structured approach, investors can build a resilient portfolio aligned with their individual financial goals.
3. Analyze the financial statements. Detailed analysis of the financial statements emerges as a fundamental aspect in making investment decisions. Carefully observing the financial state of companies provides a comprehensive understanding of their economic health. Companies boasting a strong financial position, characterized by a significant absence of debts, are more likely to thrive over time. The absence of substantial debts represents a strategic advantage for companies, giving them greater resilience during periods of economic volatility. The ability of a company to operate with its resources, without the burden of excessive financial charges, can be a key indicator of its financial stability. Therefore, when analyzing the financial statements, the investor seeks to identify companies that exhibit this robustness, thereby increasing the likelihood of long-term positive performance. Understanding a company's financial health is not limited to a one-time analysis but is an essential component of an ongoing evaluation process. A meticulous examination of indicators such as liquidity, indebtedness, and profitability provides valuable insights into the company's ability to generate consistent revenue and maintain a strong financial foundation over time. This deep understanding is crucial for supporting informed investment decisions, enabling the investor to make choices aligned with their strategy and financial objectives. In summary, the analysis of the financial statements is a crucial tool for investors, providing a holistic view of the economic condition of companies. By focusing on companies with a solid financial position and understanding the details behind the numbers, investors are better equipped to make informed decisions that aim for sustainable growth and long-term risk mitigation.
2. Long-term thinking. The adoption of a long-term mindset emerges as an essential premise for solid investment strategies. Investing with a perspective 2 decades ahead represents an approach that transcends temporary market volatility, focusing on the future trajectory of the company. In contrast to the pursuit of quick gains, the in-depth understanding of where a company will be in 20 years becomes the focal point of this investment approach. Stocks, as investment vehicles, are intrinsically linked to the companies they represent. In this context, the long-term appreciation of these stocks is closely tied to the continuous performance and sustainable growth of the companies themselves. Instead of being influenced by short-term fluctuations, wise investors concentrate their efforts on understanding the nature of the underlying business, anticipating its long-term development. Sustainable growth, therefore, takes precedence over immediate gains when adopting a long-term perspective. Considering factors such as innovation, market positioning, and adaptability to the future economic environment becomes crucial for predicting the potential for sustained growth. By doing so, investors seek to build portfolios that withstand the test of time and provide consistent returns over decades, rather than mere temporary fluctuations. In conclusion, investing with a long-term view represents a strategy that transcends the pursuit of quick profits, focusing on wealth building over time. By understanding and anticipating the future development of companies, investors position themselves to reap the benefits of long-term growth, aligning with the intrinsic nature of stocks as integral parts of business enterprises.
1. Risk management. Risk management constitutes a critical component in the investment decision-making process. When embarking on any financial endeavor, it is imperative to carefully assess the risks associated with each action. This deep analysis is not limited only to the possibility of gains but also incorporates a meticulous understanding of potential losses. Asking about the amount that can be lost and gained in each investment is a fundamental principle in this context, recognizing that constant accuracy is not an imperative requirement in the financial market is essential for a realistic approach. Historically, successful investors have understood that it is not necessary to be correct in every transaction. Instead, the focus lies in the ability to capitalize on profitable opportunities in a way that offsets potential losses. This strategic mindset presupposes a deep understanding that long-term success is not based on avoiding all adversities but on effectively balancing positive and negative outcomes. Success in the financial market, therefore, is intrinsically linked to the ability to measure and manage the risk associated with each investment decision. This proactive approach allows investors to establish clear loss limits, minimizing exposure to potential negative impacts. At the same time, it opens up space for the exploration of opportunities that present significant potential for gain. Even if they do not occur in every transaction, in summary, risk management is a cornerstone on the path to success in investments. By understanding the relationship between risks and rewards, investors are better equipped to face market fluctuations and build resilient portfolios over time.
Now that we have explored the solid foundations of investment through the insightful words of Peter Lynch, I invite you to take the next step in your financial journey. If these tips have inspired you, don't forget to leave your like and share your reflections in the comments below. We want to know, which investment rule resonated most with you? Subscribe to not miss the next insights, and let's continue unraveling the secrets of the financial world together. Let's build a space of learning and growth. Don't miss the chance to refine your strategies and be part of this community dedicated to financial success. Subscribe, leave your like, and share your ideas with us.